Okay, folks, I think we'll get started. Welcome to the presentation this evening on the top 10 financial planning tips when considering a move to Australia. We've got myself, Stephen Ford. I'm the head of UK financial planning. I'll be presenting. I have a co-presenter, Paul Lawson-Tyles. He's a senior advisor specialising in international pensions, particularly moving pensions to superannuation in Australia. We also have Simon Harvey, who is the owner and the general manager. He's in the background there, who's going to be collating any questions you ask through the evening, and we'll be aiming to answer as many as we can within the time frame allotted. If you can use the question and answer function, you'll see it perhaps at the top of your screen. If not, put it in a chat. That way we can try to collate them as we go along. I'll need to answer them at the end if you don't mind. We'll put you all on mute. That also means that if you're multitasking, doing something else, you're welcome to do that, and it won't be interrupting what we're doing. You should go through a lot of it's really just to sensitize you, because there is an awful lot of sometimes complexity sitting behind it. So we'll cover some sections in a little more detail than others, but it generally is to give you an orientation of the things that you perhaps need to consider in moving back to Australia and relocating on a largely a permanent basis. We will send you the guide or the presentation at the end. We may not have time for all the questions, we will see, but we will collate the questions and then give answers and send all that information out as well. We'll give you the opportunity, I think about 35 minutes to get through the content, give you an opportunity to ask questions then. And also, if you'd like to have a meeting with anyone, we'll provide some details at the end for you to contact us if you'd like to have a more personal discussion about your circumstances. I'm going to move into the information very quickly now. We'll start going, hopefully. I guess, in fact, I have my personal experience. I'm an expat Aussie. I came about 12 years ago. I did actually have one of the big four accounting firms try to educate me on my move over here. But sadly, I think I made some significant mistakes. And then on joining BDH, learned also there was significant opportunity. So I guess it's really important to understand that moving countries is a large task, as we know, but also has a lot of financial implications. We're really here to make sure that you appreciate some of the opportunities that may exist, also avoid very costly mistakes in the process. Oh. One of the main issues with pension transfers or the taxation systems is that the two systems, the Australian system and the UK system, are very different. So in the UK, you get tax relief on the contributions as you put in, and then as it grows, it's not taxed either. But as we know, when you try to withdraw it, 25% is tax-free and 75% is taxed. When you withdraw at a superannuation in Australia, it's not quite as simple when you've moved there, perhaps transferred money, but in essence, you will largely get a lot of it out tax-free. So you can see if you avoid the tax on the way in, don't have any growth taxation as it grows, and then you move it across to the superannuation scheme in Australia, you can largely avoid the tax. And that's, I guess, one of the strategies that we really wanted to talk to. It's obviously not quite as simple as that, but in essence, that's the main challenge or opportunity. I just want to use an example here. Let's take a couple. Both of them are earning about £70,000 each. Pension contribution, if they made £20,000 contribution, because they're in the 40% tax bracket, means they will get or save £8,000 in tax that they would pay. If they'd taken that money at 20 grand after tax, it would amount to £60,000 in savings over 5 years. If that was left in the pension, that remains 100,000. And that's true whether you're remaining in Britain or whether you're planning to return to Australia. That's a 67% automatic return on investment. And you can see as a couple, that's £200,000 that basically be put in a UK pension and would be subject to tax if you were staying to take that out. That's a 67% return. However, if you then shuffle that across to Australia and put it into superannuation, and when you're able to take it out, usually 60 or 65, you're then perhaps getting a large proportion of it, maybe all of it tax-free. So in essence, the tax you've avoided in the UK can remain largely yours. And of course, depending on how long you are away from retirement, the taxation element that you haven't paid is also subject to investment growth. You also retrieve or save the gains in that. If you're a high income earner, so perhaps there's one in the family or a single person, you're earning £140,000 and making a pension contribution of 40, which is the maximum limit in the UK. Because at £100,000, you start to lose your personal allowance. That sort of zone means that you end up paying quite a lot of marginal tax. So putting £40,000 in would mean that the tax relief would actually be £28,500, which means that if you just taken that cash after tax, it would be £57,500. But in pension terms, it's £200,000. So the return on investment is immediately an awful lot. Again, think about then transferring that ultimately to a superannuation scheme, not ever having to really pay much of that tax back, and whatever investment growth on that extra 140-odd thousand taxation that you save. So earners maxing out their pension, particularly prior to leaving, can be very lucrative. Even for a basic rate taxpayer, it still can be very lucrative depending on how it works. So for someone earning £50,000, if they made a pension contribution of £10,000, they would get tax relief of £2,000. However, if they're able to salary sacrifice, then they can avoid paying the national insurance of £12,000 that's due from a person. So really, in practice, under £50,000, you're really paying 32% tax. So you're saving that. Then on some occasions, the NI that a company has to pay on your salary is 13.8%. Sometimes they may gift all of that to you, go halves, or maybe not give you any. Let's say that we could arrange that situation, you could arrange it with your employer, then again, you would be able to make pension savings of $14,580. You get a very large return on investment, even though you're not necessarily a higher rate taxpayer, it can still be very lucrative. Now blend a high earner with a basic rate taxpayer, maybe in a family, and you can see between the two, there's still a lot of opportunity to save that significantly. I guess we have a range of people that we often deal with. Some are in their 30s, some are in their 60s. So I guess depending on how long you then got that money invested, it will grow over time. So you can see here, £10,000 contribution into a pension could grow into £43,000 net of fees, etc. after 30 years. So you can see that it can grow quite significantly if it's invested for a long time. The flip side is, I guess, if you want to get certain amount of money, eventually if you leave the pension contributions till much later, you need contribute a lot more to get the same amount out. So I guess for younger people, it still pays to, even if it's smaller amounts, use this pension system and then consider transferring to superannuation as a tactic, because the investment growth itself can also add up to a significant amount alongside the taxation benefits. So if in terms of the actions here, it's build a strong UK pension portfolio, maximise your pension contributions, particularly before you move, even if you're moving within the year, because the UK system will allow you to use your previous allowances or unused allowances for the past 3 years. You can tend to get a quite significant allowance. If there's 2 of you, then that can be very high. I guess ensure your pension is working hard for you, so the more it grows, the better it's invested in a good portfolio, the more there will be in the end. And consider salary sacrifice, particularly if you're a basic rate taxpayer mainly, because it does save that 12% NI. And if you have a defined benefit pension or a final salary pension, then it's also worth considering that as a transfer, because you will avoid the taxation or avoid a lot of the taxation potentially if that's moved into superannuation schemes.
Hi everyone. I'm going to talk about currency risk now and the opportunities that you've got within that area. So Stephen's already shown you how you can save quite a bit of money with contribution planning, but also getting the currency right on any trades that you make, of house purchase or pension funds and other such things can be very important in the success of your move. Now, as far as currency is concerned, if you transfer your money from your bank account to an Australian bank account, in general, you're going to get a very poor exchange rate. It's really tourist rates. Not much better than if you went and got your money actually at the bank for your holiday. Whereas if you go to an actual currency broker, then it is the core part of their business. It's what they do. There's a lot of them out there that have to be competitive to succeed in the field, and they will offer you a much better exchange rate. So if you think that when you go to the bank, what they will do is they will look at the interbank rate, the rate that all the financial institutions trade at. That's what they buy their currency at, and they will then sell it to you at maybe 4 or 5% less. So that's where they make their money on that top slice. Whereas with currency brokers, they're more likely to only be charging 1% or less on that top slice because they're dealing with much larger amounts each day. So they can afford to take a tighter spread on there. And so they will automatically give you a better rate in general if you just approach them and say, can I have the rate today? But where they really come into their own is where you can also set the rate that you want to try to achieve. So if you've already sold your house or if you're in the process of selling it, you can set up a forward contract or a market order with them where you say, I actually want to trade at this rate, and it will automatically happen for you if the rate hits that amount. By the same token, if the rate is dropping and there is an amount you really can't afford for it to go below, you can also set a stop loss order to ensure that it doesn't go any further than that. So it just gives you a lot more certainty about what you're doing, it allows you to try and capture opportunities that are available to you. Now, the other thing that you can look at as well is actually converting your investments, for example, into Australian dollar denominated investments, even if they're still sitting in the UK. We do that with some bigger pension funds where there are annual limits on how much you can transfer each year, but it gives you the opportunity to still move into dollars if you want. So there are lots of things that you can do around the currency that can really actually make you quite a lot of money in general. So in summary with that section, just look at Australian dollar denominated portfolios, make sure that you use currency brokers to make your trades, and speak to them about the forward contracts, market orders, stop losses, because that's where they really come into their own.
One of the key questions we often get is related to property. So either your home or perhaps a rental property that you may have retained in the UK. And one of the questions is, should I sell it before or after I leave the UK? At best, I can say this is awfully complicated, and that I would suggest if anyone's contemplating either, really high stress, should get tax advice, because it depends a lot on your tax residency. So if you haven't fully removed your UK status, then you're subject to UK tax. You need to really make sure you are wholly classed as an Australian resident in some circumstances. It then depends on the tax regime. So even if you have moved as an expat, there's still likelihood of some taxation on any property that you sell whilst you are an expat. It's the one capital gains category where the UK will tax someone on their capital gains. And that is an awful calculation because there's different time periods after which they change the rules. So that's got to be calculated. There's different methods by which the accountants calculate it to make sure that you perhaps have the cheapest method of calculating the capital gain. If it was your primary residence, then you can claim the primary residence exemption, but nevertheless, within 30 days of selling it, you've got to tell the HMRC no matter what. This is one area that is very difficult to give clear guidance on, other than before you leave, you should try to understand what the situation is. If you sell it when you are in Australia, then you are potentially liable for capital gains tax there as well. So if you end up having to pay in both countries, then you can use the double taxation agreement to try to iron that out or smooth it over or reduce the overall tax bill. But it's that level of complexity. So we strongly encourage you to get an answer on what's best. Sometimes we get asked, should I, before I go to Australia, buy my new home or another property perhaps? Definitely if you're a foreign investor, so if you're British by citizenship, then no. Foreign investors get taxed much more heavily than an Australian. If you're an Australian expat, it may be worthwhile. Sometimes you can buy the properties in advance, and because of the taxation system, there's a lot of non-cash deductions you can make, which means that you're not having much of a cash outlay, but you are making losses. And then when you return, you can claim those on your income tax on your return and reduce the losses, which won't for you be cash losses, but you will save some tax on the return. I guess the other advantage is mortgages in Australia are 100% deductible, unlike Britain now, where it's only 20% of the interest that can be claimed. Australia does, on the flip side, they have other taxes that don't exist in the UK, such as land tax. I guess you've really got to weigh up also if you're buying that as an investment property, what's the yield on that investment? I would definitely suggest getting a mortgage. Might be a bit more difficult while you're an expat, but not impossible. And of course, there's interest rate differences. So at the moment, interest rates are a little bit higher for mortgages in Australia than the UK. There's all those types of things to consider, but it is something worth considering, particularly if you're an Australian expat. I guess the last question, the property category, should I keep my UK base and rent it out while you're in Australia? I guess that's a bit of an economic equation as much as anything. You have to be very, very careful about how often you come back and whether you use that property, because that can start to signal that you're also a UK tax resident. And it only takes maybe 30 days living in a place, maybe 90 days in the country, a home, maybe a couple of family members here, and you'll be classed as a UK tax resident. So you have to be very, very careful about understanding residency rules. You can claim the taxes that you paid in each country under double taxation treaties. There are ways to deal with it, but you need to then obviously get an accountant to support you in that. I guess sometimes not necessarily an attractive alternative, because only 20% of the interest on a mortgage can be claimed, so it's not quite as profitable. It means more of it's going to be subject to UK taxation. You'll still have your personal allowances and the like to protect some of that. You really have to do your calculations very carefully to make sure it's going to actually be a decent investment for you. It maybe is something you're going to return to because you're not sure whether you're going to stay in Australia, but that's fair enough. And there's non-monetary reasons to be keeping these things, but it is really worth considering that. If it was your house or your primary residence before you left and then you choose to rent it, it just means that the time period that it's rented will start to eat away at your primary residence exemption. So you'll be starting to qualify for capital gains tax and so on. And you will also have to acknowledge the rent in your Australian tax return and rely on the taxation treaties to smooth that out. And then we'll talk about the capital gains issues really on the first topic on the property. I guess one question, it depends on the time of your life, but property is a tangible. People like that a lot. They feel comfortable that it's bricks and mortar as an investment. But for a lot of people heading into retirement, it's not necessarily the optimal retirement asset, unless it's perhaps your residence, so you save on mortgage costs or rent costs. And the reason I say that is you can't really turn the capital growth of that property into income. So if you need the income, then other investments that are more liquid, where the capital growth and any dividends or any other growth can be turned into an income for you in later life, can be a much better investment. So I guess it's also challenging the thought that a property is a good retirement asset for some people. If you've got a lot of money and you're not relying on it, that may be true. If you've chosen a good property and you know it's going to appreciate pretty strongly and you want to pass that on down through family members, that's also fine. There's loads of other reasons to keep them, but it is a decision in itself aside from just the taxation considerations. So I suggest if you are having a property and you are selling it or keeping it, you really do probably need to get professional tax advice. And certainly, I guess it's down to researching the property market. What's the future of capital gains like in that, either that property, that country, that area. Make sure you get professional tax returns done. A lot of people don't do this when they leave the country, only to find out that there's lots of things that they've neglected that they could have basically benefited from. They've got to go back and do 7 years of history. So I would stay on top of it if you plan to. But also consider the simplicity and transparency of liquid assets. It's one thing to keep some things. I guess it's another just to keep life a little bit more flexible, particularly if you're heading into retirement. And it's worth trying to make sure you understand in your whole financial picture where this asset might fit.
Okay, so in terms of other investments that you might hold when you move to Australia, it's important to also understand the tax position with those. So as well as your pensions and your property, you might hold, for example, shareholding, investment trusts, OICs, or ISAs. Any types of investments that you've got that you're considering perhaps keeping hold of going forward. It's important to understand your position in Australia. So in Australia, their taxation system works a little bit differently to the UK in that, in general, everything falls under income tax. So if you were to make a sale of a share in the UK and you made a capital gain on that, then you would have a separate capital gains tax exemption in the UK that you could rely on top of your normal threshold. And capital gains is taxed at different rates in the UK. In Australia, it's just all added to your income. So if you're already a high income earner and you make a capital gain, then it will be taxed at quite high rates. Now, if you're holding on to investments and you sell them after you've been in Australia for 12 months or more, then you can halve that gain for capital gains tax purposes in Australia. But it just falls under normal income tax rates. Now, the Australians also might view certain assets that you have in different ways. And a classic example of that is the ISA. So it's very tax efficient while you're living in the UK. And, so it's a really good way to build up your funds. Whereas the Australians don't recognise that tax-free wrapper you have there. So they will just look at what you're actually invested in. So if it's cash and you're earning interest on it, they will look to tax that interest. If you make a capital gain on your stocks and shares ISA, they will look to impose tax on that capital gain. So really, it's a case of trying to work out what you should do with those assets going forward. Now, if you're not going to need the funds for at least 10 years, then it might be worth considering using an offshore bond, because that does actually fall under a different tax in Australia, where if you've held it for 10 years or more when you sell it, you can then receive the benefits from it tax-free. So that can be quite a big saving compared to capital gains tax that you might pay on other investments. So it's certainly worth looking into the assets and working out what you need to do going forward. So really your main action points as far as that is concerned is to start looking at it in advance. Make sure that you get some professional advice in respect of what you should and shouldn't be keeping, and if you are considering whether you should or shouldn't sell it, then certainly some professional guidance can help you in that respect in trying to make sure that you make the right decisions going forward. Stephen, next slide, please. Okay, and as I said, you can consider cashing in those investments and taking the cash with you, but you still have the same problem in Australia, and you don't really have those ISAs and other things like that. So it's a case of where you put the money. There might be some good opportunities with that money, but just make sure you get your planning done as far in advance as you possibly can. So moving on. As well as capital gains tax, you also need to consider inheritance tax. With inheritance tax, The good news is Australia doesn't have inheritance tax. The bad news is that if you are born and bred in the UK, or you've been in the UK for a long time, then you would be considered domiciled in the UK for at least 3 complete UK tax years after you've left the UK. So whatever you do, your estate will still be liable to UK inheritance tax, even if you take all of your assets offshore. Now, the difference between being domiciled in the UK and non-domiciled is simply that domiciled individual, your worldwide assets are liable to inheritance tax. If you manage to break that domicile and take on Australia as your domicile of choice, as I said, it will take at least 3 years. But once you've done that, then the only assets that would be liable to UK inheritance tax would be any assets that you still hold in the UK. So in terms of planning for that, at that point, ideally, unless there's good reason to keep those assets in the UK, you'd have assets that are under the UK inheritance tax threshold so that you can leave them to your beneficiaries without any tax. Now, if you've got a particularly large estate and you're worried about that, there's some good planning tools that you can put in place, like, for example, making gifts to your beneficiaries while you're still alive. As long as you survive for 7 years after making that gift, then it will completely fall outside of inheritance tax. There's other simple things, like, for example, a life assurance policy. If you know that your estate is still going to be liable to inheritance tax for the next 3 years at least, you could have a life assurance policy that would cover the tax liability for that period until you're able to break that domicile. Now, that's important to remember, because if there is inheritance tax to pay on your estate, your beneficiaries cannot receive your assets, i.e. probate wouldn't be granted on your estate until the inheritance tax bill has been settled. So if they don't have their own funds that could settle that bill, they were relying on being able to sell assets that are in your estate. Well, that's going to be a problem, because they can't get hold of those assets until they can pay the bill. A simple life assurance policy or similar would be able to cover them as far as that is concerned, all those gifts that you might have made while you were still alive. So in summary of that section, really, it's a case of just making sure that you understand your domicile position, that you try and break the domicile if you are planning to stay in Australia for the rest of your life. Potentially dispose of UK assets, gift them. As I said, you can use a life assurance policy as well. And then other smaller things, like, for example, ensuring that on your pension, that your beneficiary nominations are up to date. Because, again, a pension could pay out to your beneficiaries as well quite quickly. And that might help with that position as well. And remember that the pensions fall outside of inheritance tax. So you can build up large pension funds and they won't count towards that cap.
I guess related to that is having a will and a power of attorney over your finances or your health. Wills, well, I've been advised at least that an English will may not cover my Australian assets and vice versa. So it pays to have a will in each country to respect the assets that are in each country, if that remains the case. One thing to understand with power of attorney in the UK is it doesn't automatically go to the spouse. So if there isn't a power of attorney, it can sometimes be court appointed. And this may not necessarily bother you because you're heading back to Australia perhaps, but if you've got parents that remained here or siblings, it may be important to make sure that you've got those in place. I do think that it's worth understanding that even if you move to Australia and you are able to pass on some of your estate to your children or other relatives, if they're located in the UK, whilst there isn't any inheritance tax because you're technically Australian and you've got the deemed domicile sorted, then you can trigger a capital gains event. So there's ways around that, but in essence, it's not that straightforward either. So if your children or brothers and sisters you want to bequeath stuff to remain in the UK, then there's still work to do to make sure that they're not having to cash in the assets to actually pay the capital gains to property, for example, or find the money independently to pay that if it's necessary. We've already mentioned that the spouses and relatives not automatically given power of attorney, so that particularly relates to relatives that you might have responsibility for. So the sure they're in place in both countries so that you're protected. Make sure that a will is in place, particularly in Australia, and that you've got cover if you're bequeathing assets to anyone in the UK, and particularly keep them up to date. It's easy to do them and not necessarily keep them up to date.
Okay, so talking about policies that you might have in the UK, so life assurance policies and similar, when you move to Australia, it's important to know how they're going to pay out or whether they will pay out. So check your policy terms and ensure that you understand the rules. You might need to actually phone the provider as well. So a life assurance policy, for example, might cover you for 3 months after you've left the UK, it might cover you for 6 months, it might cover you indefinitely, or it may not provide you any cover once you've left the UK. So clearly, you need to know that in advance so that you can arrange replacements if necessary. As far as Australia is concerned, once you get there, it will probably be a good idea to replace that cover. But remember that superannuation schemes, your pension in Australia, might well include some benefits that will automatically replace what you had in the UK. So again, understand what you've got included in there. Now, I mentioned about life assurance. There's other policies, for example, critical illness cover that might be part of your life insurance policy. Make sure you understand the rules there as well. I've seen some clauses in critical illness before where it says that you have to be diagnosed in certain countries, like, for example, a European country, in order for that cover to pay out. Now, by the very nature of that sort of cover, if you're ill enough to claim on it, then you might be too unwell to actually travel back to Europe to be diagnosed. So what is quite an expensive cover might be effectively null and void. So, make sure that you understand all those terms, that you do that research in advance, and that you check what is actually going to be included as part of your employment over in Australia, and make sure that you've got cover in place to replace your UK cover before you make any cancellations.
One small thing that can be done also if you've been working in the UK is to make sure that you top up your state pension history as much as you can. It takes at least 10 years to be eligible for UK state pension, and the maximum 35 years. And that is payable in Australia. It's just not indexed, so it'll be a flat amount. But at the moment, if you're eligible for the full state pension, that's £9,110 per annum at the moment, or 16,400 in Australian terms. So it's quite a significant amount, and it's worth making sure that you do a little bit to again contribute to that and top it up as much as you possibly can before you leave. As you may know, the Australian equivalent is income tested and asset tested. So typically a lot of people that aren't really eligible for that, whereas in the UK, it's neither. You receive it based on just your years of NI contributions. So a simple thing to do, but certainly can add up to a nice amount of money that will diminish based on inflation, but still, if there's a couple, even better if you put the two together. It's a nice little supporting income. That will probably for a lot of people won't be due till they're 67 or 68. So it does kick in a little bit later, but it's still a nice little extra amount to support you in retirement. So make sure you just check that, top up the record if you can before you leave, and make sure it's the maximum. I guess one small other choice is what actual time do you plan to leave during the year? And this actually is a little bit of work with an accountant or us, perhaps we can help you decide the timing in relation to the tax years. So, for example, if you have a lot of deductions that you can make in Australia, you would be better off having a full Australian tax year so that any of those deductions have maximum impact as you're at the highest possible marginal tax rate. So it may pay to make sure you get there just at the start of the Australian tax year. In other circumstances, it might be better to split it down the middle because you're going to be a high income in both countries. So let's say 6 months in each. Britain will tax you as though you're staying for 12, so you'll get a refund in Britain because you won't be perhaps as higher marginal tax. Same in Australia because it's an escalating scale. You may stay in lower bands, it's only 6 months of income. Between the two, just for that tax year, you might save a bit of tax. So it is worth considering how to manage that. Also, if there's capital gains involved, as Paul said, they go into the income tax system in the Australian circumstances. So it's weighing all that up. Try and decide what's the best optimal point in the year. One thing that we want you to consider is in Australia, there's no spousal transfer of assets, whereas there is in the UK. So before you leave, sometimes it might make sense to transfer an asset's ownership to a spouse, which then means that belongs to them from that point on, and any taxation related gains can then be split across two tax income brackets and make the use of allowances. So that's a big advantage in the UK, that if it was done legally before you left, and then result in a different tax situation in Australia. This is an area where sometimes poor choices can be quite costly, so it is worth considering it, and where you can possibly do it, plan for it. Even if sometimes some of the family go a little bit earlier or a little bit later, it may still be a fruitful choice. So make sure you get tax advice. We suggest even more year out, so start planning this, consider the best timing, assess the pros and cons of assets disposal, and utilize that spousal transfer if it makes sense, but do it before you leave the UK and before you become an Australian tax resident. So to plan that. And don't forget, a lot of people do because they don't realize the tax situation. It's not quite like Australia, that tax is taken out if you're PAYE, for example, as though you're working there for 12 months. And so if you only work for 6, then you do a tax run. A lot of people forget to even claim it. Make sure you do.
Okay, so we've talked about all the opportunities of moving, but quite often people think, well, what if it doesn't work out? So again, yeah, it's something that needs to be considered in planning. If you are over in Australia and you've decided that you're going to return to the UK in the future, then that would need some planning. Just like at the moment we're talking about planning before you move, well, it would be planning before you move back. Now, it's again very important to understand your position and ensure that you don't fall into any pitfalls at that point. A big example of that is pensions. So if you were to transfer your pension over to Australia and you then return to the UK, well, the Australian authorities do not allow you to transfer the pension back from your superannuation scheme to a UK scheme. So there can be the opportunity to potentially actually draw the money out of the Australian scheme if you're old enough to do so, receive everything tax-free from it and bring it back to the UK as cash. But you have to have been in Australia for at least 5 years. If you were to draw funds out of your Australian scheme and then return to the UK within 5 years of having first left the UK, then you would find that there's some retrospective tax to pay on that amount that you received. So like anything really, the main action points as far as that's concerned, I mean, it's obviously a bit negative to be talking about it just at the moment when you're just planning your move over there, but it's an important thing and it is something that we get asked quite a lot. What if it doesn't work out? Well, again, it's just a case of making sure that you understand the options that are available to you and ensuring that you don't do anything like, for example, take the money all out of your super fund without realising what the potential consequences could be. It can be a really good opportunity. It could present a really big tax headache if you get it wrong. So just make sure that you get it right and that you do your planning if that is the case. Stephen.
So, folks, that's the end of the content. So, in a moment, I'll hand over to Simon, and he can read up some of the questions that have been asked and give the answers. What I will do, though, for those of you who might like to go because you don't want to stay on, is just leave this sitting on the page while we do the questions. But if you want to chat to an advisor, that's at no cost, no obligation, because you want to discuss your personal circumstances. Then if you'd like to just send an email to this email address, and if you could help us out just by stating your age or ages, if you're a couple, and roughly what year you might be planning to return, that will just help us decide which advisor to have speak to you. Some like Paul deal with immediate or very soon transfers. Others of us deal with those who are perhaps planning to stay in the UK for a lot longer and don't quite know when they're returning, or it's in a broad time frame like 5 years. So we'll just leave that there. I'll hand over to Simon now. I think he's going to start just reading out some of your questions and answering them for you.
Hi, everyone. We've had a number of questions about the state pension, and in particular, how to pay top-up contributions. In order to be entitled to the full state pension, you need 35 years of contributions. That can also be contributions that you qualify for by caring for a child under the age of 14. So not necessarily working, but caring for family. That can be a qualifying year. If you have any shortfall on the 35 years, you can make voluntary contributions, and you can go backwards up to 6 years to top up. And then you can also make contributions prior to reaching state pension age in future years whilst Australian resident. Whether it makes sense to do so or not will depend on a number of factors. But if you compare the cost of purchasing a guaranteed annuity to the cost of the state pension, it does represent good value. Again, on the state pension, we've been asked whether you need to keep a UK bank account open. And really, that depends on what you intend to do with the state pension. Some people like to have it paid into a UK bank account so that they have the money available for trips back to the UK. But equally, the DWP can pay that pension directly into an Australian bank account at retirement age, and the rates are generally quite competitive. So that just takes a lot of the hassle factor out of it. Regardless of whether you remit the funds to Australia or not, the income is accessible to Australian tax if you are resident in Australia and have a permanent visa. No, it's actually 92% of the state pension is accessible to tax, and you get an 8% tax-free amount. But yeah, regardless of whether it's remitted, it generally is accessible to Australian tax. Okay, so we've had a lot of questions about pension transfers to Australia, including whether you can have a UK pension paid directly from your current UK scheme to you as a resident of Australia. And yes, you can is the short answer to that. But if the pension is paid to you as an Australian resident, the ATO will deem it as a foreign super, and it will be accessible to Australian tax. Whereas transferring to an Australian scheme enables you to access the pension tax-free, which is why it generally makes sense to transfer pension funds to Australia. We've been asked about whether if you leave money invested inside a UK pension, whether that continues to grow tax-free. Yes, it does continue to grow tax-free whilst it's held in the pension vehicle. But as I mentioned earlier, it's taxed when you then extract it. If you transfer the pension fund to Australia, there is a potential tax charge on transfer to Australia. and that's based on any increase in the value from the date you arrived in Australia to the time of transfer. Now, looking at where you can transfer the pension fund to, we've had a number of questions about that, and whether there are any limits on what can be transferred. In terms of limits, you can transfer up to $300,000 every 3 years. So if you have a larger fund, it does take a number of years to transfer the funds across to Australia. There are alternative strategies for people that have significant pension funds where you can release the whole fund very shortly after your arrival in Australia, completely tax-free, on the proviso that you are already at retirement age. We've been asked whether the pension fund can go to a typical superannuation fund or whether it usually needs to go to a self-managed superannuation fund. It's a good question. Generally, public offer funds in Australia are funds that are set up to be widely available on a commercial basis, do not qualify to receive UK pension transfers. There is a single public offer fund that is recognised by HMRC and able to accept transfers from the UK. If you don't wish to transfer to that fund, your only other option is to use a self-managed superannuation fund, which is a scheme that you need to establish in your own name. It gives you a large amount of control with the fund, but there is a lot of administration work and responsibility involved with running your own fund. That's where firms such as ourselves can come in, because we can take a lot of the pain out of that for you. And ultimately, it's generally a worthwhile exercise because of the tax benefits. And moving your money to Australia also means that you can then invest it in Australian dollars and remove currency risk from your situation. We've been asked if there's any merit in leaving the UK or arriving back in Australia in a particular time within each respective tax year. Yes, is the short answer, but it depends on your circumstances. There might be capital gains tax advantages for moving at a certain time, i.e. early in a new tax year or late towards the end of a UK tax year. There might be income tax advantages if you leave early in the tax year, because you might have 1 or 2 months salary, but you've got the full UK personal allowance available. So it depends on your specific circumstances, but yes, you can plan to make the move tax effective from that perspective. We've also been asked if there's a specific amount that you need to transfer to Australia in order to be able to transfer your pension funds. No, there isn't a specific amount, but because it is quite a niche process, and you often need a self-managed super fund or there's a single public offer fund, the cost associated with the transfer might not justify going through the process if you have a balance of, say, £10,000. You could generally just withdraw that at retirement age and within the nil rate band in Australia. It would be taxable for, as income, but you have a nil rate band and that income might fall within it. There's a question around splitting your time between the UK and Australia in retirement. This is something that comes up quite often. People like the idea of spending 8 months of the year in Australia and 4 months in the UK over the British summer. That comes up quite often. And what does that mean from a tax residency perspective? Australia generally has a couple of tax residency ties. So there's something called the 183-day test, where if you spend more than 183 days in a particular tax year, you will generally be resident there. And you'll also generally be resident from the time that you take up that you move there with the intention of it becoming your main home. Common misconception is that if you go down to Australia to validate a permanent visa, that you will be tax resident from that point in time. But that's generally not the case unless you are actually moving there, shipping your personal effects and getting a home there at that point in time. A lot of people go down just for to validate the visa and to do some research. That generally will not trigger tax residency. If you do spend significant time in both countries, it is possible to be tax resident in both. And then the situation gets quite complex, and how to deal with that is really beyond the scope of this webinar, but we can certainly advise on that on a one-on-one basis. We've got a question about if you have an existing UK investment advisor, are we able to work with them to determine best outcomes? Yes, we absolutely can do that. Because what we do is very niche, we often work with other financial planners both in the UK and Australia, and can work with them to either transition the case across to BDH or to support them in delivering advice to you. So yeah, very much happy to work with you and your advisors. We've got a question about taking tax-free cash from your UK pension, and if you do that, can you still transfer the remaining 75% to an Aussie super account? That's a really good question. Firstly, whether the lump sum is tax-free will depend on whether you're UK resident at that point in time. If you are, the lump sum is tax-free. If you're in Australia, the lump sum is not tax-free. Once you take the lump sum, you then fully crystallise your fund, and you can't make partial transfers from a fully crystallised pension fund. So if the fund exceeds the Australian transfer caps, you then prohibit yourself from any transfer to Australia. So you need to be very careful about taking lump sums from your pension if you wish to transfer to Australia in the future. If I keep my property in the UK and rent it out, will I be able to get my UK personal tax allowance to set against property income before taxation? Yes, you will. UK rental properties are always accessible to UK income tax. You will get your personal allowance, but if you are a permanent resident or a citizen in Australia, the income will also be accessible to Australian tax. So, yeah, you might get the UK personal allowance, but the rental income will still be accessible to Australian tax. If you are paying any UK tax, you get tax credit in Australia for UK tax paid. We've got a question about what happens to children's JISAs or junior ISAs if moving to Australia on a temporary residency visa prior to gaining PR. It's actually quite an interesting question, because if you are on a temporary residency visa, you're only accessible to Australian tax on any Australian income. So selling any overseas asset will not attract Australian capital gains tax if you are on a temporary visa. Once you get the permanent visa, the ATO will look straight through the ISA wrapper and tax any dividends or gains within the junior ISA wrapper. So if you switch between funds in the junior ISA, for example, whilst Australian permanent residents, that would be a taxable event. We've got a question about carried forward losses on Australian rental property. Can you offset this against Australian income on your return? Yes, you generally can do that, and we would be very happy to advise you on that. So yeah, I would suggest getting in touch, and we can talk you through your options there. We have a question about stocks and shares, ISAs, and becoming an Australian resident. Will the capital gains tax liability commence only from the point you become Australian resident? Yes, it will. You will be deemed to have purchased the investments for their value at the date of arrival in Australia. So depending on when you move and how strong the currency is at that point in time will determine the base cost for those assets. And then when you come to sell them, you'll be taxed on any gain from that point onwards. We've got a question about applying for a temporary residency visa and how you become an Australian tax domicile. So, two kind of issues there. A temporary visa holder, a temporary resident visa can allow you to be tax resident in Australia. Now, tax residency is distinct from domicile. Domicile only relates to UK IHT, and to be Australian domicile, you need to establish that that is where you intend to spend the rest of your life. If you're moving to Australia and you have no intention of returning to the UK, it's generally quite easy to acquire a domicile of choice in Australia, and therefore be off the hook for UK IHT. It is still possible to acquire an Australian domicile if you have a temporary visa, but it is trickier. Stephen, how are we going for time? Is
2 more minutes left to the half hour.
2 more minutes left. I've got a couple of more questions that I'll tackle. After that, if you just want to send any through to us, we'd be happy to help you. Okay, so someone's asked me to expand on my question around taking tax-free cash from your UK pension and then transferring the balance. Yes, you can transfer the balance after you've taken the tax-free cash, but the balance needs to be within the Australian contribution limits in order for that to be possible. So Australia caps the amount that you can transfer in a single tax year. Prior to the age of 67, you can transfer $300,000 in a single tax year with no further contributions for the following 2 years. So if you take the tax-free cash and your remaining pot is less than $300,000, it would still be possible to transfer that to Australia. If the remaining pot was more than $300,000, because it exceeds the contribution caps and because you can't make partial transfers from a fully crystallised fund under UK pension legislation, it wouldn't be possible to transfer that amount. Okay, I think we're just about done with the questions, Steve.
Okay, there's just a few more in the chat, so we might just say goodbye to everybody else. We'll stay in, we'll just answer the questions in the chat itself, and then you're welcome to leave as you wish. I appreciate all your time. Hopefully that's been valuable for you and you've learned a lot. I guess it is a complicated area, as you understand. We've tried to keep it something that is relatively simple in the way it's communicated, but it's not always as simple underneath. I guess we've also talked lots of topics. One challenge is to weave all this together for you. So because there's a number of strands of this, they're all interrelated. Part of what we can offer is piecing it all together for you as well, so that each individual issue is working synergistically, if you like. So I appreciate all your time. I wish you all a Merry Christmas and a Happy New Year, and thank you. Bye. Simon, would you like to, I've started answering some of the questions in the chat. I don't know whether you just want to look in there and then just pick up the answers.
Yeah, I think I've just about covered most of them now, Steve. There is one in there about the base cost for capital gains tax if you've got periods in and out of Australia. So if you've got multiple periods of Australian residency, and there is no short answer to that one. It's a it depends question. So I think that's really one to get in touch with us on separately, and we can deal with that on a one-on-one basis.
Debbie had a question there, Simon, about buying a flat for her adult son, whether that would be, if she paid for it, it was in his name, be a gift, or would it attract capital gains tax?
Oh, I didn't see that one there. So, yeah, it would be a gift, and it would be what's called a potentially exempt transfer for IHT purposes. So if you are still UK domiciled for inheritance tax purposes and you make substantial gifts and then die within 7 years of making that gift, and it can still form part of your estate for inheritance tax purposes. So yeah, it's just something to be aware of. But you can make the gift without any immediate tax charge.
There's one from Peter Lewis. Can you confirm that temporary residents in Oz can sell UK property without facing tax as opposed to being in an Oz permit?
Yeah, so if you're a temporary visa holder, you can sell UK property without any Australian capital gains tax. There is a caveat to that. If your spouse or partner has a permanent residency visa, you are also deemed, or you won't qualify for the foreign income exemption. But provided you and your spouse, if applicable, are both temporary visa holders, you will not pay Australian capital gains tax on the sale of a UK property. You might still pay some UK capital gains tax, depends on whether it qualifies for a primary residence relief, and also if you've accumulated gains post 2015. But generally, if you've got a property portfolio, for example, and you've held it for a long period of time, there can be significant UK capital gains tax planning opportunities if you sell post departure and shortly after arrival in Australia. How many years is required to pay into UK state pension to qualify in order to claim it after moving back to Australia? Good question. It does change. It has changed quite a lot recently. I think at the last time I checked, it's 11 years is the minimum number of years you need to pay for in order to qualify. So if you're at 6, 7, 8, 9 years, it definitely makes sense to make those voluntary contributions to ensure you qualify for some state pension entitlement.
Pete, you've asked about the capital gain tax rate in Australia. They don't have a separate capital gains tax rate like we do in the UK. There is no separate threshold. There's no different tax rates. Any capital gain that you've made will just be added to your income tax bill, and you will pay it at whatever your marginal rate of income tax is, except, as I mentioned earlier, if you have owned the asset for 12 months of Australian residency, you will be able to halve the gain that is added to your income.
Another question by Ingrid, is there a time limit on pension transfers of my age or time in Australia? Simon or Paul?
Sorry, I didn't catch that one, Steve.
Oh, sorry, Ingrid asked, is there a time limit on the pension transfer either my age or time in Australia?
No, you need to be resident in Australia to make the transfer without a UK tax charge. 67 to make the transfer without meeting a work test. After the age of 67, you can still transfer, but you need to meet a work test. That work test requires you to be gainfully employed for a period of 40 hours within a 30-day period. And as long as you meet the work test, you can transfer up to the age of 75. There are limits on the amount you can transfer, but yes, it is possible to transfer some funds up to the age of 75.
I think that's one other question. Where is it? From Ingrid again. I don't know if Ingrid's still there, but I don't quite follow the question. If I sell my property in the UK for 10,000 and buy a place in Australia, what do I do? Quite sure what that means.
We do have a question here about whether an Australian farm would be exempt from IHT in the UK. Yes, I imagine it would be if the farm qualifies for business property relief. So in the UK, if you have a business or a working farm, and if it qualifies for business property relief, it will be outside of the scope of UK IHT. That's also likely to apply if you have an Australian working farm. We've got a question about whether you can transfer a pension before the age of 55. No, you can't transfer to Australian superannuation before the age of 55. The next best thing that we can do is manage your money in Australian dollars within a UK pension fund. And that's what we often do for our clients, to remove currency risk, long-term currency risk from their situation and give them certainty with their retirement planning, is to have their pension fund invested in the currency of their retirement expenditure. So yeah, if you're beneath the age of 55, speak to us about investing in Aussie dollars within your UK pension.
That's about it, is that?
I know there's a question about the 3-year domicile in Australia and whether it reduces proportionately throughout that period.
The answer is no. Yeah, it's you need to be clear of be clear of the UK deemed domicile rules. You need to have a domicile of choice in Australia, and until you can tick both of those tests, your full estate will be accessible to UK IHT.
That all? I think we've covered them all.
Yep.
Any others, gents? One more from Sean. Oh.
Yeah, good question from Sean. If he maintains a UK property, when that UK property is assessed in Australia, do Australian tax laws apply? i.e., can I claim the full interest tax deduction against my Australian tax? Yes, you can. So unlike the UK, where we limit the amount of tax relief that you can obtain on interest, rental mortgage interest, in Australia you can claim a full deduction despite the fact that the property is in the UK.
One more in the chat. Thank you.
We did have a question earlier about whether you can split a UK pension fund between husband and wife. The answer is no, unless you get divorced, which is extreme financial planning.
I did actually have a client suggest that as a course of action once. They were considering doing it.
Were they?
A bit extreme at the time.
Okay, gents, well, I think we might wrap that up and conclude the presentation. That way I'll be saved and recorded as such. So thanks for your time, Simon. Well done. Thanks, Paul.
Thanks, everyone.
Bye.
Thank you.
Bye.